Let's talk a bit about the economic outlook right now and the challenging winter that we are expected to have here in the U.S. For more on that conversation, we're joined now by Stephen Rattner. He is the chairman and CEO at Willett Advisors. He was also the head of the Auto Task Force under the Obama administration. Stephen, great to have you join the program today. I'd love to begin with your view on the economy as it stands today. Chair Powell is expected to speak on the Hill in about 20 minutes. He's calling the outlook extraordinarily uncertain. Is this something that rings true with you?
Yes, I think extraordinarily uncertain is certainly an apt word, but I think we can sort of drill down on that a little bit. I think what we're looking at is an economy whose recovery is slowing very, very dramatically. We're going to have another monthly jobs number on Friday. The estimates are all over the place, but it's certainly going to be fewer jobs than we've been adding, and possibly even a loss of jobs. But what's obviously happening is the effects of the stimulus are wearing off. We're going into another phase of lockdowns or reduced activity or whatever it is you want to call it. And all of that is going to take a toll on the recovery. And so the recovery is still proceeding at some pace, but I think we are in danger of stalling out without more help from the government until we get to the other side of this third wave or second wave or whatever it is you want to call it.
Steve, it's Julie here. It's good to see you. So as we await that commentary from Jay Powell and Steven Mnuchin today, how are you thinking about, I mean, obviously Powell has pushed for more fiscal stimulus, but how are you thinking about the monetary stimulus side of the equation? Has it been appropriate? Obviously it can only go so far, but has it been appropriate, and how long do you think it should last at this level?
I think the reason why Chairman Powell is pushing so hard for fiscal stimulus is because he recognizes, as most of us do, that monetary stimulus has not quite run out of steam. There's always more things you can do, but it is getting to the end of its rope. And as of course, monetary policy, of course, operates in an uneven fashion. It reduces interest rates, it provides liquidity to borrowers. And so anyone who's involved in the credit markets as a borrower or a lender or whatever has an effect. But for the average American, home ownership maybe, but not so much. And so that's why he's pushing so hard for stimulus. I think there may be other things he can do. For example, there's talk about yield curve control, which basically means holding down interest rates further out on the yield curve. But I don't see them doing anything right now. I think they're very focused on trying to get another package of trying to urge Congress to pass another package of stimulus, very focused on what the Biden administration is going to want to do. And so I don't expect any dramatic action from the Fed in the near term.
Stephen, let's stay on stimulus here. Do you think the airline sector will need an auto-like relief package, and do you think that sector can be saved as the auto sector was saved?
I think the airlines certainly are facing challenges, and they've already gotten substantial federal aid, as you know. They may well need more financial aid, but my issue with how the aid was provided so far and my views as to how it should be provided in the future is more along the lines of what we did with the autos rather than what the Trump administration did. In other words, I would, as a condition of getting government aid, you would expect the private stakeholders, the equity holders in particular, to absorb a fair amount of pain in return for the government rescuing their company. And that was not done the last time around when Secretary Mnuchin led the airline stimulus package. And so I'm open to more stimulus for the airlines. I think it may well be needed, but I think it needs to come on terms that are more favorable to the taxpayers who are providing this money.
Do you ultimately think the government should be taking stakes in the major airlines?
Well, we did not. In the case of the autos, as you know, and the implication of your question, we did take a majority stake in General Motors, a smaller stake in Chrysler, not because we wanted to, but because we had to protect the taxpayer. We were providing in total to the whole industry $82 billion of capital, and it was our job as fiduciaries to ensure that the taxpayers got back as much of that as possible. It wasn't possible to get it all back. If we had provided it in debt, the company simply could not sustain that level of debt. And so we took equity as a way for the taxpayers to get more money back. And that, in fact, worked. And that is essentially the course of action that I would recommend for the airlines if they need more capital.
Stephen, as you're talking about the condition with the autos, it's been so interesting in this crisis that the financial sector, the banking system, really was not the epicenter of the issue. I mean, if you go back to 2008, there was no capital available. That's sort of how you guys got forced into those sorts of positions. What does that set up for the next phase of the recovery? Capital markets are still working, but we still have to get a pandemic under control. What does the recovery look like to you in a year or two time?
Yeah, you've identified very correctly a key difference between this crisis and the last crisis, which is that the capital markets are functioning. And I would say I am slightly surprised, slightly pleasantly surprised at how well they've been functioning, that even companies that have gone into bankruptcy have been able to get debtor in possession financing. A large part of why we did what we had to do with the auto industry was because there was no private capital available. Same with my colleagues who were saving the banks. We needed government capital. We have provided government capital through the Fed programs and so forth, but the capital markets are otherwise working pretty well. So I think that's going okay. I think the good news about the economy is that if we get past this very difficult period, there is a lot of pent-up demand. People have saved at an enormous rate. You've seen the savings rate numbers. They also got stimulus checks and other forms of payments. And so the consumer is in very good shape at the moment, those who are working. And there's a lot of pent-up demand, people who have not been able to travel, they've not been able to do things they like to do, or travel for business for that matter. And so I think you will see a lot of that resume as soon as it is safe from a public health standpoint to do it. So there will be, I think, a positive jolt to the economy from that. Whether it's enough to bring the economy back all the way without more long-term stimulus, economic development kinds of measures, I think is very questionable. But we'll get a positive bump when the vaccine takes effect.
And Steve, finally, one other difference between now and then, as you're sort of talking about, is that the manufacturing sector during this crisis has actually held up fairly well. I mean, we just got some numbers out from IHS Markit, the November manufacturing purchasing managers index at 56.7, which matches the original reading that was already strong. So as you talk about, if we see this rebound in services, hopefully coming out of the pandemic as the vaccine is more widely distributed, if you continue to see some strength in manufacturing, I mean, what kind of economy are we looking at coming out of this in terms of strength and in terms of sort of character and complexion?
You're correct. The manufacturing sector has been reasonably strong during this. And that relates to a few things. The dollar has been falling, which makes our exports a bit more competitive. Secondly, people haven't been able to use services in the sense that they haven't been able to go to Disney World, they haven't been able to go to movie theaters, haven't been able to go to sporting events. So they have, to some degree, continued to buy stuff, whether it's on Amazon or online or however and car sales have been reasonably good. So not being able to kind of quote consume services, they've consumed more manufacturing goods. But longer term, I don't know that the structure of the economy has changed that much. We are a heavily service-based economy. Our manufacturing as a share of our economy will likely to continue to fall simply because other countries are more able to make things better or cheaper or both. And we have to deal with that. I think the Trump administration was very Pollyannish about suggesting they could bring manufacturing back to where it was in the 1950s, things like that. That's not going to happen. We have a service-based economy. And once we get past all of this stuff, I think you will see those trends resume of a strong service economy and challenges on the manufacturing side.
All right. Stephen Rattner is the chairman and CEO at Willett Advisors. Stephen, thank you so much for taking some time to talk to us this morning. I hope we could talk soon.
I hope so too. Thanks for having me.